The next panel is hosted by Vinnie, along with Cameron Gleeson from Betashares, Steve Garth from Principia, and Michael Furey, and we're talking through the managing through factors.
Thank you so much, Francie. Geez, Toby, if I knew I was walking into an active passive debate, I would have dressed accordingly and left the gloves at home. Which is a good segue to the next topic here. Look, for us, the active-passive debate is over. Firstly, because the results, they are emphatic as they are devastating, but also because of what we're talking about here, factor and smart beta. It is totally wrong to lump passive all into one category. Sure, there is a sleeve that is market cap exposures, like the ASX 200 and S&P 500, but there's been an evolution and new thinking of finance theory and actual applications that have occurred, which now allow for two things. Firstly, improvements in index methodologies. We run index funds at Betashares, and we're the first ones to highlight there are flaws in traditional indices. Using the share price, using issuer weighted for fixed income has its flaws and limitations. But there's been improvements on that. There are now indices that overcome those issues and limitations. And then secondly, what we're talking about today is factor investing. So in a rules-based way to actually capture the return premia that active managers seek to capture. And to cover that, I'm going to welcome up on stage the panellists. So Cameron Gleeson, Senior Investment Specialist at Betashares. Michael Furey from Delta Research, and Dr. Steve Garth from Principia. Welcome, folks. Cameron, I'm going to let you start with a few slides.
Thank you for that kind introduction. I'm going to try and sidestep the SPIVA debate to the best of my ability. I just want to sort of start by saying that, you know, let's try and be a little bit more less adversarial and say that, like, there is a place for all types of investment styles in a portfolio. And I think in that debate of active versus passive, a lot of people appreciate that, yes, using some low-cost market beta in equities can make sense, but then I might need to blend that with something else, give myself a different return profile. I have particular investors that have different needs beyond broad market beta. And I want to talk about, you know, the options for doing so. Now, you know, one investment style that is very popular is quality as an investment style. We heard Jason talking a bit about, you know, using active managers and understanding the style and their approach and the way they generate alpha. And I just want to sort of talk about that. How do I get a different return profile in my portfolio? And thinking about the typical, not every single active manager process we use this for quality, but typical process that a quality manager might go about to construct that actively managed quality portfolio. So Miski World has 1,423 stocks in that overarching index. It's almost impossible to do fundamental research on every single one of those stocks. So how will an active manager who pursues a quality style approach seek to build that portfolio? Well, the first step they're likely to do is screen that overarching universe to create a shortlist. They're likely to screen perhaps on metrics like return on equity, financial leverage, cash flow, and alike to generate a shortlist. The second step of that process is then that sort of that, if you like, the trying to generate alpha out of your universe. So you take that short list of stocks, you build a financial model, you go and talk to management, you get some research done, you adjust your growth expectations, adjust the valuation to decide which stocks you should hold and which you should exclude. I guess my point is that as investment professionals, what we need to do when we're evaluating a manager like that is to try and determine whether what is delivered from their return profile is due to step one or step two. And if it is indeed step one, that profile of quality companies, then, you know, recognize that there are alternatives. There are smart beta, if you like, or factor indices that can deliver that very same return profile, but with lower cost. Now, here's an example of two indices which we use. These are indices used by two of our ETFs. And I just want to talk briefly about the blending of factor indices. Now, it is important that when you're looking at a smart beta index, it's not just about selecting the companies, it's about how those indices actually construct a portfolio. What's the weighting methodology? How do you combine stocks in that universe so you avoid unintended consequences? The chart on the right-hand side is one that that's a chart I just fall in love with every time I see it, but it's showing the rolling 12-month excess returns. Those two lines are almost a mirror image. When the quality index is underperforming, that value-oriented index is outperforming. Negative correlation. So we can see that blending certain factors can make sense. When both factors deliver outperformance over the long run and you blend complementary factors, this can be a very strong approach to building portfolios to avoid drawdowns. Because it's important to note, and I'm sure we'll talk about it, is that factors also undergo cycles and they have periods of underperformance. Looking for complementary factors, looking for ways to drive diversification are critical because I think we'd all acknowledge it's very difficult to time the market. The benefit of a rules-based approach to factor investing is that typically with a rules-based approach, while we can't predict the next phase in the cycle, we have a high level of confidence as to how that factor index will perform in that phase of the cycle. Now, really briefly in fixed income, we believe a smart beta approach, if you like, is appropriate in fixed income. As an ETF provider, we only deal with investment grade fixed income. So I'm going to, give you leave aside private credit, leave aside high yield. But in fixed income, it is very difficult to pursue what you'd consider a traditional equity style factor approach of quality and value. And this is actually a different slide I use for a different purpose. But just to look at this, what we see in investment grade credit, these are 4 corporate bonds, similar characteristics, but issued by entirely different issuers. What we tend to see is very little dispersion in investment grade credit. The equities for 3 of those issuers are shown on the right-hand side. A lot of dispersion. Opportunity to generate alpha on the right-hand side. Very little in investment grade credit. To cover your transaction costs alone would eat up most, if not all, of your potential alpha if you'd picked the right bond to hold and the right bond to short. So as Jason mentioned, what do a lot of funds do to generate outperformance in fixed income? They stuff it with credit. This is the Ausbond composite, very small allocation to credit, around about sort of 8 to 10% corporate credit. Another way to approach fixed income, if your portfolio needs more credit, and deciding your allocation to defensive assets should depend on what you have on the growth side of your portfolio. What complementary exposures can I bring in from fixed income? And the biggest levers in investment grade are credit and duration. Here we see a smart beta approach that Bloomberg has produced or has created to overcome some of those shortcomings of the traditional Ausbond composite, which gives you a nice blend of both credit and traditional government bonds in a fixed rate exposure. So this is an example of a smart beta index. These funds are all available, obviously, in a low-cost ETF form. The great thing about index-based approaches is that they are transparent, they're rules-based. So when looking through a portfolio, you have good insight into what's driving returns. And I guess what I would say is, in my viewpoint, they are more dependable over the cycle when looking to build a portfolio. I'll hand over to Vinnie so we can start the discussion.
Thanks, Cam. Grab a seat. Thanks for that overview on factor investing. It's really interesting, gents. The Professor Cam Harvey from Duke University a few years ago listed out in one of his papers some over 250 different type of factors. I think Research Affiliates did a paper on that too. But we just start with what are the main factors that investors should think about? Steve, maybe we can start with you.
Yeah, thanks, Vinnie. That's right. I've seen that work. There's 250. Another paper had 330 factors. You go, that's crazy. So what do we mean by a factor? And I think the way I think about it, a factor's got to be something that's going to lead to a higher expected return over time. Otherwise, what's the point of doing it? And you think about, well, for that, I want something that I can see in the data for the longest data I can see. Can't be just something that I can see in 10 years, which a lot of these factors pop up. They're very short-lived. So you want something that, as long as you can see in the biggest data set you can get, you want to see it around the world as well. If it just works in one country, you go, oh, that's not really a factor either. That's just some anomaly in the from that country. I guess the third thing is it sensible? In other words, the major factors are all kind of based on valuation theory. That makes sense. A lot of other factors are just data mining. And I guess the last point, is it implementable? Can you do it in a cost-effective way? And that only brings you then down to a couple of factors that we've seen in the data, value, quality or profitability, and the small cap effect as well. They're the 3 main factors that you see in data around the world, whether you're talking about emerging markets or developed markets or in Australia.
Yeah, so I absolutely echo your sentiment. There needs to be some, if you like, justifiable rationale for that factor existing. And also extend to momentum and yield as a factor in equities to broaden out. There are other factors like, liquidity that people talk about. But in terms of investable factors, I'd sort of, isolate that as, some people talk about low beta or minimum vol. So you perhaps got a toolkit of up to 6, depending on your viewpoint as to the efficacy of some of those factors.
I just add, sorry, Michael, still have it. You've got to be careful of momentum as a factor. It's absolutely out there. It's not actually in every country in the world. It doesn't appear to be in Japan. But otherwise, yeah, momentum, it's quite strong here in Australia. But if you implement a pure momentum strategy, that in theory is going to lead to really high turnover, and therefore it gets rid of whatever expected return that you might get from it. So just saying that you've got to be careful how you implement these things.
Mike, anything you want to comment
difficult,
there?
Difficult to add. So for those that know me, I run an analytics system, and so we use, there's the 6 big factors in our model is the market, which is dominant for pretty much anything that's long only and what have you, and then we run value, and growth is pretty trendy at the moment. Well, growth is sort of negative value, so it's really the one factor. Although profit growth can be an independent factor, which has been very, very successful over a long period of time. Not really available ETF style and what have you, but that's where you go to active to probably access that. Size has been mentioned. That's probably the weakest factor of all. Globally, size is more of a high beta factor, and the alpha risk adjusted or beta adjusted is sort of basically 0. So that's one where we use in our portfolios all the time, and right now it looks quite attractive because it is cheap, so valuation's coming through. But it's one where I think we need to have probably a bit more care than we have in recent times. And then as the guys mentioned, quality, min-vol's like low beta, risk-adjusted alpha, but it's been a struggler in recent years.
Fantastic. Cam, I might throw this one to you. So how can asset allocators and model portfolio constructors think about factors?
So I guess I probably differentiate myself from some of Jason's comments. I think it's quite difficult to sort of time the market and decide when to use, for example, quality or value. And I think I sort of showed there in the slides, I would have a preference for combining complementary factors, understanding that they have a factor exposure will typically have a higher risk than broad market systematic exposure, and therefore looking to use complementary factors I think is the best approach. I think it's very difficult to time the market, but if you can use a consistent exposure, which how it will perform at different stages of the market cycle, then that can really help. I talked about quality and value. They're clearly very complementary. We do typically see these days, for example, whether it's size, yield, and value tend to perform similarly. And right now, momentum and quality are up to the last 2 months have been delivering quite high correlation. Momentum can shift around though a lot. So, but there's typically sort of various ways to look at these different underlying drivers of return to build that all-weather approach, which is less susceptible to drawdowns in any one single factor.
And Mike and Steve, both of you are on investment committees that portfolios that use factor investing. Keen to hear your insights.
I'll jump in. So if they're true factors, they're somewhat independent and uncorrelated as well. Okay, so complementary factors are often, it's a short-term phenomenon. So in recent years, we have seen growth correlate with quality. That doesn't have to be the case. Okay, if you think about, say, utility-type stocks, which are sort of cheap and boring, they're nice, consistent profitability. So they've got value characteristics and quality characteristics as well from a profitability perspective. So, but I guess go back to the question, I suppose. The way I design portfolios, there's sort of 3 components of risk I break managers down into in our portfolios. There's the market, which is our asset allocation decision. Then we look at the factors. And for me, the factor decision is, it's sort of your philosophy. What do you believe works in markets? If you're a value guy, you want to make, you make sure your portfolio reflects that value philosophy. Okay, so the factors is very much a philosophy. You believe in them or you don't. And the final one is I guess that idiosyncratic. If you believe in skill, then you're capturing that third component of risk, which is alpha, pure alpha, after factors, after the market.
Because those factors are now available as they're democratized.
For the most part, yeah.
Yeah, and I'll just add a little bit to what Michael said, which on the whole I agree with. Having any strategy based on a single factor, that's going to potentially lead to a lot of pain for a lot of time. But when you start combining factors, because they're not highly correlated, at times they are, but over the long run, these factors come in different ways at different times. So we were talking before about what a tough time value's been having. In fact, that's only got to do with the US. Value in Australia has actually outperformed over the last 10 years. Value around the world, ex-USA, has actually been, if you look at the MSCI World ex-USA Value Index, it does better than the MSCI World ex-USA Growth Index. So we've got one particular group of stocks that have shot the lights out, and they are on the growth side. But in fact, if you turn up your quality filter, then you actually end up including those stocks in the portfolio. So having a pure single factor strategy, yeah, that can be a hard one to wear. I think a multi-factor strategy, because they're not highly correlated, they come in and play at different times. I think that's good to explain to clients because it's evidence-based and you can show the long history of how these factors have led to an outperformance. And by the way, just to go back to something we started with, a lot of people think these factor-based strategies are passive strategies. It's the wrong word. I think you started off, Vinnie, by saying, the debate on active versus passive is dead. We shouldn't even be talking about that. A systematic strategy is, if you like, it's an active strategy. There are some stocks that are overweight and some stocks that are underweight relative to what an index would have. So don't think of beta, multi-factor, they are beta strategies, but doesn't mean that they're passive strategies. They're actually an active implementation.
That's fair. Mike, just touching on your point, Cam, you made also, I mean, should active managers, irrespective of the debate that was in the earlier session about comparing active managers to SPIVA or a market cap benchmark, should active managers be measured against their true factor?
Yeah, yes, but I think all active managers should have the benchmark that represents their investment universe, right? And I think Global Investment Performance Standards was mentioned before, which I think has the best definition for really what represents a benchmark. It should be market cap, it should represent the universe, it should be liquid, etc. Right? So that is the primary benchmark, always should be the primary benchmark. However, you can use factor benchmarks to get a really good feel in terms of understanding the active manager's performance behaviour. You can see the correlation between the appropriate factor and their performance to make sure that they are true to label. You can use that benchmark to determine what the component of risk is in terms of that factor and their overall risk. You can use that factor to work out the actual beta. You can have deep value, sort of shallow value. You can have everything in between. But using that factor benchmark can give you a better flavour for the sort of factor strategy or active strategy that you're looking at with respect to their style.
Yeah, I just endorse what Michael said, but to me that there are two ways to look at this. One is what the client sees, and the client should see the most vanilla index you can find, which is, say, the ASX 300 or the MSCI World. Even APRA would say, don't go presenting clients some, like a MSCI World Value Index or a MSCI World Low Volatility Index. Clients don't know what that is. They probably don't know what a MSCI World Index is, but at least it's the most vanilla index out there. So that's for the end client. But for the advisor, you should absolutely be comparing the returns of the manager against a similar factor-based index. Now, it doesn't mean that the manager has to beat that index. There are different definitions of value, different implementations. The way MSCI, the index provider, would implement value is going to be quite different to the way value managers will. Quality, there's a dozen different definitions of quality out there. But what you do expect, as Michael said, is that you're with a manager that's going to have a value tilt. You at least expect them to look like a value index. They don't have to beat it. They have to have the same characteristics as that. Otherwise, you're not getting what's written on the label.
I'd agree with everything that's been said there, and clearly there's a need for practitioners such as the gentleman on stage here to really evaluate funds that we choose to put in our portfolios. One gripe I have about the use of benchmarks is where an active manager pursues, say, a high conviction style, and say growth stocks, concentrated portfolio, and then uses that benchmark to calculate a performance fee. And we've seen numerous examples of that where a performance fee, in my view at least, should be, risk adjusted. If I'm pursuing a portfolio which is higher risk than the overall market, then my outperformance shouldn't be based on taking exposure to growth stocks or quality stocks. It should be, based on providing good risk-adjusted returns. So that's one gripe on benchmarking with particular active managers.
Is it benchmark or the performance fee?
The use of a benchmark to calculate a performance fee when you deviate from that benchmark from a risk standpoint. That's
a whole nother discussion, Vinnie. Why don't we have one on performance fees?
We need to have a proper, great debate. But anyway, I'm just conscious of time. One topic before we throw open to questions is just assessing these smart beta factor approaches. Now, Cam, as you know, we've done some work ourselves on this in presenting to clients how they should view the framework. Research Affiliates, one of our partners in the US, Rob Arnold's group, has done some great work, and essentially it summarises the same questions that you ask of an active manager, you should ask of factor investing, i.e. how do you win? Who's on the other side of your trade? Where are you currently trading on your valuations? Now, on the passive side, we can easily articulate those things, but I'm just really keen to hear from all three of you. How do you view these factor strategies? How should they be assessed by investors?
In my view, let's just say you're looking to implement a factor style using I'll call it a rules-based approach. That's my preferred term rather than index. I think you are looking at long-run performance. We need to see consistent evidence, but we need to expect that there are going to be periods of underperformance and understand that the return profile is consistent in terms of those likely periods of underperformance. We're also looking at clearly the portfolio construction, because it's not just about selecting the best value stocks or the best quality stocks. It's about how you build that portfolio, how you ensure you don't have too much stock-specific risk due to a rules-based approach, and then obviously fees. So we tend to see that a rules-based approach versus another fund, the chances of it outperforming on a very short-term basis might be a 50-50 split. Look at the longer-term returns to see whether or not, for example, the high cost load has an impact. Sort of look at that consistency over time, look at long-term returns, but expect periods of underperformance for particular factors.
Yeah, actually, I'll just add to that. Having a factor-based investment strategy actually requires a long-term view. All the evidence looks at whether these factors, revert to mean, stuff like that. And to a certain extent, they do. Value's out of fashion for years. It'll no doubt come back in at some time. But trading on that's really difficult. All the academic papers I've seen said it's impossible to sort of trade on an expectation of mean reversion. So factor-based strategies tend to work best for long-term investors to sit and hold, because again, these different factors come in at different times. They're not that well correlated. So the long-term strategy is best. One thing I will add to what Cameron said, if you are looking at, say, a factor-based active manager as opposed to an active-based rule manager, well, actually costs are important. You're kind of buying beta. If you're buying a factor-based strategy, that's just another word for beta. If these factors have got long-term higher expected returns, well, there's nothing, and it's in basic valuation theory, well, there's nothing alpha about that. That's actually just beta. So make sure you're not overpaying for alpha. Make sure you're not getting mixed up between what's alpha and what's beta. So I would always say, if you're looking at a factor-based active strategy, make sure you're not paying too much for that, because you can get these much cheaper.
I guess what springs to mind for me, like at the moment, there's multiple ETFs with quality as a factor. So I think when comparing those as an example, you need a framework that is consistent. So if you are invested in quality, you have a quality methodology, if you like, or a benchmark perhaps that you believe in, and then you compare all of your quality strategies, all your active quality strategies to that particular benchmark so that you can consistently understand, is that idiosyncratic risk adding value? Is the factor representative of the quality that you want, as an example? And then I guess when it comes to any ETF or factor-based sort of semi-passive strategy, you want to understand that the tracking error is extremely tight, and they're actually representing the index or benchmark that they say.
I'll just add, some of the work that research affiliates have done on this is actually constructing an analytical tool and comparison tool. Mike, you've looked at it in a lot of detail, that actually has a whole array of different smart beta and factor exposures, but it gives you the answer on, firstly, where is this factor strategy currently trading in terms of its valuations? Is it expensive, fair valued, or cheap? And then it answers the second question of incorporating market impact and transaction costs, which, look, let's face it, we're the first ones to highlight, is the dirty little secret of passive investing. More concentrated strategies like an active manager are going to have high market impact turnover costs. So it accounts for that. And then it shows you forward-looking potential alpha based on a mean reversion scenario. So if anyone wants to have access to that, let me know, and I'm happy to send you the link and the login for that. But let's pause there and just to throw open to any questions. Maybe from Rob?
There's always somebody you can rely on. Rob?
I guess I need to clarify my previous comment in the sense that I heard the word adversarial used, and I'm not adversarial against ETFs and passive investing and etc. I think they've got a great place in the ecosystem, and in fact passive cannot live without active and active cannot live without passive. That's the reality. It's about the swings and roundabouts between those. My comments were about the methodology of a particular study, so that's a separate thing. I was curious about the debate that was going on about measuring a factor portfolio against a standardised benchmark versus the actual factor benchmark. And I wonder why, if a factor benchmark has an investable alternative, such as an ETF that tracks it, why wouldn't that be an appropriate measurement tool in understanding whether a strategy or a portfolio was adding any value over time? And by the way, the comment about using a standard index for the retail investor makes perfect sense. But at the advisor level, they're more sophisticated at that and they can understand these kind of nuances.
I think we did say that you use a factor-based benchmark as a measuring tool. Definitely. It's not the primary benchmark, but it's a very valid benchmark for taking that next level analysis to understand, is that active strategy a reflection of the factors that it says that it has exposure to? And then, I think I also mentioned, you want to assess the idiosyncratic risk over and above that to see if they're adding any value there, as well as that understanding the beta exposure to that factor, as well as how much risk that factor contributes to the overall portfolio risk. So it's definitely important. I think it's just not the primary benchmark. It's definitely a secondary benchmark.
But it's definitely something advisors should be looking at when in their strategies. They should absolutely be using a style-based benchmark to see whether the manager's doing what's written on the box. What did the manager say they were going to do?
Vinnie?
Look, there was a very important topic that was touched on but kind of dismissed, which is this concept of risk. Now, risk, there are many risks in investment, and one of them could be volatility, but volatility is both an opportunity and a risk. And the main risk in volatility is that people have these stupid questions in risk profiles. So when would you bail out of an investment when it had gone down by 10%, 20%, 50%? I'm thinking, now the only risk there is if the investment is run by a manager who hasn't done his or her job, or whether there could be a very sharp, because in most market downturns, the highest growth is always after the highest drop. So in our practice, or in our licence, we're encouraging advisors to get rid of the term risk profile and call it an investment profile. And we try to get them to drop some of these stupid questions out of the risk profile so that they're realistic questions that really get to the sensitivity to volatility, so you can take that into account. Now, we've got a room full of a lot of advisors, but RG244, I think it's 0.139, has a list of questions that advisors should ask their clients. And they list about a dozen, and they say there are many more, as all of the factors of the risks. Now, the only mention of risk in those, there are two risks mentioned. One is the risk of loss, not of volatility, the risk of loss, and the other one is the risk that the investment will not achieve the outcomes required. And those risks, I just think it's crazy. We've got this whole investment business predicated on this thing called risk, which is defined by one of the umpteen number of risks there are in investment. It's the only one that's quantifiable, so that's what they use to quantify risk. It's just stupid, in my view, and in the view of our whole management team. We're intending changing it, but it's.
I would agree with you.
You mentioned about having risk-adjusted returns. The risk adjustment is just the level of volatility.
Yeah, I try to
which
take
means
the word
that
risk out of all, that investor profiles is what we call it, not risk profiles. The idea that volatility, if you're a long-term investor, volatility is not a risk. The risk for your end client is catastrophic loss. That's it. So using risk as a definition of volatility is mad. I couldn't agree more.
There's a question.
Well, I disagree.
Sorry, go on, Michael.
I'm going to slightly disagree. Look, volatility is a measure that shows you how far away from your objective, what your potential loss may be. So if you've got 20% volatility of equity market compared to 5% with bonds, okay, over any period of time, your underperformance, and you've got an expected return, I would hope, for the asset class, is very, very different. So if you've got a 12-month time frame and you invest in equities and you experience that 20-40% volatility on the downside, right, then you've got to take notice of that volatility. It's an important measure for understanding that downside potential of your underperformance, of you not meeting your objectives, which we know is the true risk. Okay, so it's not, volatility is not going to tell you whether you're going to meet your objectives or anything like that. Absolutely, but it's a measure that is important for understanding, maybe in a probabilistic potential or just in terms of setting expectations around. I guess meeting those objectives to a degree. Now, if you when you take active risk, when you go to factors, when you go to skill-based stuff, right, you may underperform, and that's something that that's a risk you are taking, which is a volatility tracking error risk or whatever, which I think is important. If you don't if you just go passive, then you're going to get that asset class return, and you take zero active risk, except for the obviously lower fees.
Yeah.
I think it's an important measure.
There's a question from the app here, which is that the number of listed companies on the New York Stock Exchange has fallen by 25% since 2000. Has that changed the dynamics of factor-based investing? In that market, we've experienced similar sort of contraction in Australia.
Yeah, I mean, look, my view is that the US equity market is still like the most liquid, most traded market in the world, and there should be enough in that opportunity set to generate returns with, whatever your style of investing is. There were some comments earlier today that, perhaps that's impacting the ability to invest in smaller, if you like, the move towards private markets is impacting the opportunity set for value. But, I still think that market is rich enough. And there's enough, trading volume and activity there to be able to execute. The Australian market, no different. The Australian market is nuanced when you're taking a factor approach because we have a market that is quite skewed to a couple of particular industries. But if you're building your portfolio appropriately, I think you can still work with these styles of investing, even in a smaller market like Australia. So certainly the US is big enough and bad enough to be able to play in with factors.
Okay, I just say the concept of whether markets are efficient or inefficient is a debate that no one really talks about anymore. It's irrelevant whether markets are efficient or inefficient. How do stock markets work? They've been working the same way since prehistoric times. People come and voluntarily agree on a trade to buy or sell, and in that way, nothing's changed at all. I don't see anything's changed in today's stock market from the way it back is 70s or the 50s.
I think we're out of time, Toby.
Okay, well, I've got one last question, which is I heard
You're allowed, Toby.
Yeah, exactly, because I've got the microphone apart from anything else. Steve, you talked about these are, you want to hold this factors for the long term. Michael, I heard you say that you want to be assessing whether a particular factor is over or undervalued or fair value or whatever. I didn't quite get a sense of what that meant for how much frequency of trading, how much turnover this style of portfolio management was likely to lead to.
I guess from my perspective, given my comments on it's well suited to long-term investors, there's very little change once you set your manager and they're delivering on what they promised in the first bit in a factor-based approach. There's not much room for change, which is not to say there's no room for review, but there tends not to be a lot of change. It's probably different for Michael, though.
I can talk about maybe just briefly just the risk modelling that we do. Looking at, I showed quality and value. We have models used to basically look at ex ante risk, and we'll make minor adjustments to those two factors because we know that relationship does shift slightly over time, but it really is generally pretty incremental in terms of the changes there.
I guess momentum's the one where there's the highest trading costs, probably the best factor pre-trading costs in terms of returns, but it's got the highest transaction cost. And I guess the other factors are just going to differ depending on market behaviour. You get a really strong run in small caps. All of a sudden, those small caps aren't small caps anymore. So you're going to get turnover if you're going to be consistent to that factor. Today's value stock may be tomorrow's growth stock. So it just depends on how. We saw a bit of a shift in 2022. All of a sudden. Value stocks are a little more expensive, and maybe some of those value stocks aren't so much value stocks anymore. So it sort of just depends on market regimes, and that transaction cost turnover is going to be very variable and depends on market conditions.
Cam, Steve, Mike, thank you. Thank you all for listening.